I'm here live at the NASDAQ market site with Federal Reserve Governor Jay Powell, who is also the head of the Federal Reserve Bank Supervisory Committee. Jay, thanks for joining us.
Great to be here.
And I want to get into some of the regulatory issues that are so important to all investors out there, especially those in the banks. But I want to ask about monetary policy to start with. You've said that you think that rates ought to rise slowly this year. But I haven't heard you say how many times you think rates ought to rise this year. What's your number?
Well, so I haven't really put a number out there, but I would say that if the economy continues broadly on the path it's on, I could see a couple more rate increases this year, which would be a total of 3.
You've also said that you think the Fed ought to begin reducing the balance sheet. Do those two things work together or separately? Would the Fed stop raising rates and then begin to reduce the balance sheet?
Not necessarily. When we reduce the balance sheet, that will increase debt held by the public, which could put upward pressure on long-term rates. To the extent that happens, we would have to take it into consideration, but the effect might be fairly small. Of course, if there is a bigger effect than I would expect, then that would be taken into consideration in setting rates.
You talked in your speech this morning about some estimates from staff about the effects. Maybe you could put them into a little bit of English for us. How much would yields come off, or sorry, rise if the Fed follows through on a balance sheet plan here?
So you look at this through the eyes of these highly complicated models, and they suggest pretty modest effects. So a few basis points here and there. But so really, I think a better way that I like to look at it is how did the market react to the news that we put out? So I think based on the March and May meetings, we talked about moving forward the expectations of the market to when we would start.
From mid-2018 to 2017.
Correct, to the end of 2017,
yeah.
we would start reducing full reinvestment. And the market reaction was pretty small on that. So that gives me some confidence that there may not be a big market reaction. As I said, it's very hard to predict markets. You know, I try not to do that, and if the markets do react more, then I would support our reacting.
Have you been surprised, though? I mean, I keep reporting these things and think that the market's going to have some kind of reaction, that this $4.5 trillion balance sheet is going to go down. Where's it going down to? What's a number to think about?
My own thinking, it really depends on a whole bunch of factors which haven't been decided yet, but it's hard for me to see the balance sheet getting lower than $2.5 trillion, let's say. 2.5 to 3 trillion, and that assumes that we normalize the balance sheet over the course of the next 5 years and go back to a fairly small number of reserves.
Let's talk about the economy. The inflation numbers have been going the other way on you. You were on this approach towards your 2% goal, and now they've come down. For 3 months. It has not moved towards your 2% goal. How much concern is there that inflation is going the wrong way?
I watched that very carefully. The March and April readings were weak, were sideways, as you say. But there's good reason to think that we're still on that path of gradual increase. In particular, spending data has been pretty strong. Labor market data has been pretty strong. So if those things continue, then I would expect that they would continue to put some upward pressure on inflation, and we continue to move back to 2%. But this is the thing where we have to show our commitment to getting to 2%. So we've got to be guided by the incoming data.
And one of the things you have to be guided by is the expectations for fiscal policy. How has that changed over the last several months?
My thinking hasn't really changed, because I've always felt that, first of all, I feel like it's a 2018 event. You know, the effects on the economy, if any, would be felt in 2018. And it's very difficult to incorporate anything into 2017 because we don't know the timing, we don't know the scope, we don't know the character of what will happen. If you assume, as I do sort of assume there'll be some tax cut, then it would probably provide some support for the economy in 2018, but it wouldn't really affect 2017.
Do you have a number that you're building in that if these things happen, that this means X to GDP?
It's really hard to say. I mean, I'm not thinking of it that way until it gets done, right? So, and we don't have to do that for this year. So I think you think about a tax cut that might be in the range of 1% of GDP. It would raise GDP by a fraction of GDP, you know, over a period of 2 or 3 years.
Let's turn to the banking side. Stress tests are coming out soon. I guess sometime the end of this month or so, you'll release this information. Banks have complained about them. They say they don't have enough information. You're not transparent enough. Now that you're in this new job as being head of the Bank Supervisory Committee for the Fed, how do you want to change these stress tests?
Well, we're committed to running, you know, as transparent as possible and effective as possible a set of stress tests. These are very successful, very important post-crisis innovation, and we want to continue and strengthen that. So we do hear these complaints, and you know, we are working now, as we have continually, to provide more more information, more transparency. Particularly, we're working on something that we'll do in the coming months, which will provide much more granular information about our expectations for loss rates on particular portfolios of corporate loans and other kinds of loans. That will help. We'll also provide more guidance when we announce the results on June 22. We're going to provide more guidance on how we think about the qualitative requirement. And we're also going to seek comment from the public on how we go about providing more transparency.
President Trump, when he signed his executive order, said he was going to do a big number on Dodd-Frank and called it, quote, a disaster. Do you agree that a big number has to be done on Dodd-Frank, and is it a disaster?
I would say that the post-crisis reform program has been mostly completed and has mostly been successful. I think it's our obligation now, as we reach completion of it, to look back over it and ask what aspects of it may be redundant or inefficient or utterly essential and should be protected down to every letter. But there are going to be some adjustments, and I think that's only appropriate. Much of this new stuff was novel, and it would be very surprising if we got it all exactly right the first time.
You've talked about scrapping the Volcker Rule, among other things. What are some of the other ideas that should happen with Dodd-Frank?
Well, on the Volcker Rule, it's not, what we're working on is a way to implement it. Congress makes the laws, we implement them, and we're working on a less burdensome way to implement that. I think we're also working now on a reset, really, of how our supervision interacts with boards of directors. We're going to move to a more principles-based approach, and we're going to eliminate many of the really specific directives that we give to boards of directors. The idea being we want directors to focus on their main job of overseeing and holding accountable the management, not running the company, and not getting tied up in a lot of checklists, but being freed up to think about the strategy of the company and the performance of management.
Finally, Jay, there's a couple jobs open on the Fed right now. This vice chair of bank supervision is open. There could be a Fed chair job open. Your name was mentioned as a potential Fed chair in a recent Wall Street Journal article. Are these jobs you're interested in? Have you been talking to the administration about these jobs?
So right now, I already have several jobs at the Fed, and I'm extremely busy these days doing them, and so I'm not going to have any comment for you on that today.
So you don't say if you're interested or not, you just no comment?
Correct.
All right, last question I have for you. When we go and potentially reduce our or scale back some of the Dodd-Frank rules, you're also going overseas to Basel and dealing with our international partners. Is there a danger the U.S. won't be leading the world anymore towards tougher financial regulations?
I believe that we will remain a committed and collaborative participant in international forums, including Basel. I think that the changes we're making will be in harmony with what we've agreed at Basel, and will be about making bank regulation more efficient and more effective, and will not fundamentally change what we've done.
Fed Governor Jay Powell, thanks for joining us this morning.
Thanks, Steve.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.